An accountant's 5-step method to maximise business tax savings this financial year with tax planning for your small business. Tax planning is the process of organising your business's affairs so that, as far as legally or commercially possible, your business income tax liabilities are reduced and minimised. Working out your business's tax plan is often overlooked by SME business owners due to the complexity of tax regulations. But tax planning is like a financial roadmap, helping you to plan ahead and make well-informed decisions that could have the effect of saving your business tens of thousands of dollars. If you're not tax planning, you're likely to be wasting money on taxes that could be better reinvested back into your business. Here is the accountant's 5-step method to maximise your business tax savings this financial year with tax planning. Work out your expected business results, profit or loss. The first step is essential. If you're looking to save tax, you first need to have an idea of what your expected profit or loss will be for the financial year. It doesn't matter whether your business is expected to make a profit or a loss, you just need to know. The reason you need to know is that tax planning strategies used for a business in a profit situation are different from the strategies used for a business in a loss situation. Generally speaking, businesses in a profit situation look to find ways to reduce the profit and thereby reduce the tax. Whereas businesses in a loss situation may look to understand if there are any tax savings to be had if they find ways to reduce the size of their loss. 2. Work out owner wages and income. The thing to do is to estimate the individual owner's income and tax forecast. If there are wages to be paid to owners, then you will want to forecast total wages and withholding tax to the 30th of June. If there is investment income, for example, from dividends or stock market or a private company, you want to do the same thing. Forecast the total investment income to the 30th of June. Maybe there are rental properties involved, then the same thing. Again, forecast the total investment income or loss to the 30th of June. Step 3, review the group tax position. Now that you have the likely tax scenario for all entities and individuals, the next step is to review the group tax position that is for all the entities in the group, companies, trusts and individuals. Review the group tax summary will allow you to identify opportunities within the group. For example, if your business structure is a family trust, is it better to distribute 50% to mum and 50% to dad, or would it cost less tax to distribute 100% to mum? If your business structure is a company, there are reasons why the company must pay a dividend. For example, to clear out and repay directors' loans. Or what effect on tax will it have if the company pays out a fully franked cash dividend? The ultimate aim of this exercise is to find ways to engineer an overall lower tax position for all the entities in your group. Step 4, alternative tax scenarios. With your group tax position thoroughly analysed, we now want to estimate the impact different scenarios will have on your collective tax position. Depending on your business and personal circumstances, some of these strategies may yield large tax savings. Here are 7 ideas and examples. Increasing owner's wage by paying a performance bonus or a director's fee. Number 2, reducing owner's wages, thereby reducing the size of the business loss. Number 3, sell unused business assets and buy assets the business needs to grow over the next 12 months. Number 4, prepaying 12 months of business expenses such as rent or insurance before the 30th of June. Number 5, making personal superannuation contributions. 6, consider making a tax-deductible donation by the spouse in a higher tax bracket so that you maximise the benefit of that deductible donation. Number 7, consider realising a capital gain in a low income year rather than in a high income year. Step 5, finalise your group tax position. Now that you've considered the tax planning options, you have also thought about what is financially possible based on your particular circumstances. You have determined the tax planning strategies you're going to adopt. The final step is to compare the original tax forecast position to the final tax plan position. This will provide you with an estimate of the total tax you are going to save this financial year. To recap, estimate business results, owner wages and income, and review the group tax position. 2, brainstorm alternative scenarios to engineer an overall lower tax position for the group. Consider strategies such as increasing or reducing owner wages, selling unused assets, prepaying expenses before the end of the financial year, making personal superannuation contributions and donations, or realising capital gain in a low income year. Compare the original forecast with the final tax plan to estimate your total tax savings. If you've enjoyed this video, please click like and subscribe. If you've got any comments, please leave them below. I'll try my best to respond to all comments left.